I like to start off the show with just a summary of what I saw happening with the stock market. I consider the asset management portion of retirement to be one of the key areas for success. And so, as much as possible, I'll try to educate you about what I see, and maybe that helps you going forward as far as that goes. And this week was really fascinating. We had a really good week going, all the way through Wednesday. Big up days, markets moving very strongly, lots of green on the charts. And then the CPI number came out at 7.5% on the inflation. The expectation was 7.2 to 7.3. Again, the market kind of shrugged that off. It fell on Thursday morning and then, came back up. It was up in the green. And since then, we've had lots of down markets, including what's happening today. And the first catalyst was the situation where one of the Fed governors came out after the CPI number came out and said that he would be very aggressive on raising rates, looking at a 0.5 point increase in March and a full 1 point altogether by July. This is much higher than the market has expected, so there was a big adjustment to the downside after that. After hours, there were other, Fed governors that came out and said that they didn't agree with that they would be looking more at a 0.25 point cut and all of these things that are happening. And then today we were kind of moving along really on a little bit of a negative basis, but and then there was kind of an announcement that they felt that Russia, invasion of Ukraine might be imminent, even to happen before the end of the Olympics here, and the market has sold off on that as far as that goes. So I think one of the key things that I look at when I try to look at what's going on is really, how does this affect the economy? So how does the inflation situation affect the economy? How does the situation in Russia and Ukraine affect the economy? And the reason that's important is because, stock market downturns happen all the time. The average downturn without a recession for the S&P 500 is 15%. The average downturn with a recession is 36%. So I'm really much more concerned about the 36% down than the 15% down, because that's kind of a normal motion for the market as far as that goes. So if we look at what's going on right now, is this inflationary environment that we're in right now going to cause a recession? Is the situation in Russia and Ukraine going to cause a recession? In my opinion, right at the moment, is that the answer to that is no in both cases. That's possible longer term, but maybe not here this year or even early next year. And that's because if you look at what's going on, first of all, the economy is very hot. It's doing very well. Leading indicators are doing fantastic. Earnings are up tremendously, 36% up in the third quarter, 29% up here that are being released right now for the fourth quarter results that came out at the end of last year. We're seeing really, really good things happen in terms of the earnings, which ultimately will be the driver of this scenario. And so it's hard to imagine recession kicking in right away. So if we look at kind of just peel back the layers a little bit on inflation, what's happened with inflation is that we had a situation at the beginning of the pandemic where demand dropped more than supply, and we actually had lower inflation at the beginning, say spring and summer of 2020. And then demand started to pick up. A variety of reasons. People started feeling better, started getting back out more. A vaccine came out. There was several big stimulus bills, one that came out at the end of 2020 and one that came out at the beginning of 2021. And so people had money in their pockets, and we ended up with this big surge in demand, and supply couldn't keep up for a variety of reasons. One of the biggest of which is that people weren't coming out to take the jobs that they needed to kind of build up this supply chain again. And so supply is not keeping up with demand. It's outstripping the supply. So that's an inflationary environment. It's also been exaggerated by the fact that people are buying more goods than services. So in other words, people feel more safe ordering goods on Amazon than going out to a restaurant or getting in an airplane or going and staying at a hotel. And so we're getting this, big amount of money that came out all being focused into a smaller area, and we're having a bigger inflationary impact on goods than services. So there's a whole bunch of things that can happen with inflation to make things better. Number one, we're probably going to see demand start to drop naturally just because a lot of these stimulus pieces are now burning off. We're hopefully, if the virus can settle down a bit, people will start moving around more and using some services instead of just goods. And we'll start to see more of an even spread of the money coming out into all of the different areas, which would slow down inflation. And then, of course, the Federal Reserve is going to be pushing on demand, right, with the rate increases and those types of things. And so that should hopefully start to lower demand, especially by the second half of this year. And then I'm a big believer that supply will continue to get better. And we saw the job numbers come out, so people are coming out for work at a higher rate, as we saw from last week. But more importantly, I just believe that companies, especially these great companies that we like, are able to kind of meet demand. They're really good at it. If you tell a company, hey, you can make more money if you go out and find a way to get the supply, they're going to try to do that. And so, American companies as a whole and even global companies around the world are really good at meeting supply demands. Not right away. It does take some time. There's a disconnect. Demand can turn on just like that. People can just open their wallets and start moving. Supply takes time to kind of build up that chain. But I do feel like by the second half of this year, we'll start to see better supply. And so the combination of those bring down demand, bring up supply. You end up with less inflation. And so the opportunity there is in the fact that the market is expecting massive inflation and huge number of rate cuts. We went on Wednesday. There was the market expected a rate increase of 0.5% on March, 24% expectation. After the Fed governor's announcement on Thursday and the CPI number, it jumped to 99%. And look at the interviews with all the other Fed governors, none of them agree with that. So once March's increase comes around, and if it's not 0.5%, we could see, a jump upward in the market. The expectation for total, rate increases is 5.5%. So far, that's continued to come up, and the Fed governors continue to come out and talk about 3 to 4. And if that happens, you'll have a motion upward. But ultimately, I do think that inflation gets under control at some point in time, and that's when we'll start to see the readjustment from this very negative outlook on inflation to something more reasonable, and that brings up the stock market. And so those are opportunities. If you look at the last 6 months, if you look at the Vanguard Total Stock Market Index, the one that I follow is VTI. It's a exchange traded fund. For the last 6 months, it's down 0.02%. So basically zero. All right, so it's flat, but it was up 6.8 and down 4.7 at its peaks and its lows. And so when you get that type of sideways churning market, the best strategy to use is to rebalance the portfolio at those low points. And that's what we've been doing. And it's been working quite well as far as that goes. And, because if semiconductor index, for example, that I have in my portfolio, if it drops, because of some inflationary fear or a situation that could happen in Russia and Ukraine, I want to buy more of it, honestly, because there aren't that many semiconductor companies, and they're really, running flat out, and that demand seems to be continuing, and more products are using semiconductors, et cetera, et cetera. So I think it's a key area that people could make money on, for example. So you want to rebalance in this scenario. You also want to keep most of your money in very broad-based indexes, just because you can't tell is it going to be energy and financials because inflation does stay hot? Is it going to be growth type issues, large growth and what have you, technology that does better if inflation isn't as hot? So I can't tell you exactly what's going to happen there, and I don't think anybody can because of the number of variables at play here. And so having a big chunk of broad-based piece is important. If we look at Russia and Ukraine, every single time we have a geopolitical situation like this, an invasion, a different war, the stock market drops initially. And there's some concern there because oil is involved. And so we're seeing a spike in oil right now as as this information comes out. But historically, after that drop, things settle down and the markets come back. And so you got to take a look at the Russia-Ukraine situation and say to yourself, does that impact the economy to the point where we would have a recession? Unfortunately, in a lot of these conflicts, there's an awful lot of money being made and selling of weapons and different things along those lines, and it can sometimes be a stimulus to the economies. So we'll see how this plays out. I don't think it'll be a great thing. I do not think this is going to be a situation also that creates a recession personally. So again, on those dips, as people kind of pull back based on the fear of this situation happening, that's a good point to buy. So these things could change, things could get worse, and then you want to be able to have more defensive situation for that. But in the interim, until proven otherwise, this is a sideways moving market where you should be basically rebalancing and trying to take advantage of these situations. So, when VTI was down 4.7%, if you're rebalancing there and it comes back to zero, you made money on those pieces that you bought, at that lower point in time. And that's how you can make money in a sideways motion market. Maybe not enough to really create huge rates of return, but what it's doing is it's setting you up. You're continuing to purchase good shares of good quality situations at lower prices. And then if the market ever does take off again, you're kind of raring to go, and you would benefit from that as far as that goes. And that's been my outlook. I think the first half of this year is going to be a lot like the last 6 months, and the second half of the year could be much better. So anyway, that's what's going on right now. Really interesting time frames, all kinds of different variables happening and throwing at us. And that's been very true for the last couple of years and doesn't seem to be changing now. But I look forward to seeing what's going to happen next week, and I'll obviously report that also.